The US dollar is facing a dramatic and concerning decline, experiencing its steepest drop since the 2008 financial crisis. In just 1 week, the dollar index DXY has fallen from 108 to 103, sending shockwaves through global markets. This sharp plunge has highlighted the growing uncertainty surrounding the U.S. economy, with investor confidence in America's economic future rapidly waning. Traditionally, during times of crisis, investors have turned to the U.S. dollar as a safe haven. But this time, the market's response has been far more unpredictable. Several critical factors are driving the dollar's freefall. The current administration's aggressive trade policies, including sweeping tariffs on key trading partners like Canada and Mexico, have triggered fears of retaliation, which could lead to a decreased global demand for U.S. dollars. The looming threat of a trade war is adding to concerns about the dollar's stability. Inflation is also on the rise, with expectations jumping to 4.9%, the highest level since late 2020. This inflation surge is squeezing consumer spending and eroding investor confidence. The Federal Reserve's Atlanta branch has forecasted a 2.4% contraction in GDP for the first quarter, further stoking fears of an imminent recession. Meanwhile, while the U.S. economy falters, Europe and China are surging ahead. European stock markets are climbing sharply, fueled by increased defense spending and stimulus efforts, while China's domestic policies are boosting consumption and strengthening its economy. Gold, traditionally seen as a hedge against currency instability, has surpassed $3,000 per ounce, signaling a massive flight from the U.S. dollar. At the same time, U.S. Treasury yields are sinking as investors brace for potential rate cuts from the Federal Reserve. As the U.S. economy slows, capital is fleeing to foreign markets, leaving the dollar even more vulnerable. Despite reassurances from government officials about maintaining a strong dollar policy, the outlook is grim. Financial institutions like Morgan Stanley have downgraded their forecasts for the dollar, pointing to the slowdown in the U.S. economy and increasing competition abroad. The policies that were supposed to stimulate growth are now working against the dollar, exacerbating inflation and placing further strain on financial markets. The impact of tariffs on Chinese goods is becoming increasingly apparent. These tariffs affect key players: the U.S. consumer, the U.S. importer, and the Chinese exporter. U.S. companies already dealing with supply chain disruptions are unable to replace Chinese imports with domestic alternatives. As a result, companies like Walmart are passing on these costs to American consumers, already struggling with rising prices. The further decline of the dollar is only deepening the crisis. Morgan Stanley's forecast of a weaker dollar is coming to fruition, signaling growing recession fears. While the dollar rebounded after the 2008 financial crisis, the current situation is vastly different. Ongoing trade conflicts and the administration's aggressive stance have led to a broader rejection of U.S. goods, resulting in counter-tariffs, anti-American sentiment, and declining company earnings. Even the European Union, despite its own economic challenges, is preparing countermeasures in response to U.S. tariffs, adding to the pressure. U.S. companies are bracing for significant revenue losses as demand for their products wanes, further weakening the dollar. The administration's economic policies are under increasing scrutiny, and consumers, already dealing with low financial confidence, will find it difficult to absorb the financial burden of these tariffs. Consumer spending is already on the decline, and broader economic sentiment continues to worsen. In response, the Commerce Secretary has attempted to frame the dollar's decline as a natural correction, but this shift in narrative suggests growing concern within the administration. There's even speculation that the government may be deliberately engineering a recession in an effort to restructure the economy. As tariffs rise, companies face higher costs, and a wave of unemployment may be on the horizon. Despite the risks, the administration remains committed to its fiscal strategy. The national deficit continues to grow, and the U.S. is becoming increasingly dependent on imports. The trade policies that were meant to benefit the economy may ultimately weaken the dollar further. Even Trump's tax cuts, projected to reduce government revenue by $5 trillion over the next decade, may not be enough to offset the negative consequences of his trade policies. The burden of tariffs will fall on U.S. consumers, worsening the economic crisis. Major financial institutions like J.P. Morgan and Goldman Sachs are predicting an increasing likelihood of a recession within the next year. Some officials remain hopeful that the U.S. economy will eventually benefit from the trade policies, But the window for a positive outcome is rapidly closing. The prospect of avoiding a downturn is growing more unlikely, and global economic powers are unlikely to acquiesce to U.S. demands without significant pushback. Meanwhile, Tesla finds itself embroiled in a growing storm of controversy, and it's far from over. Rising concerns about the company's questionable practices and Elon Musk's increasingly erratic behavior are pushing European financial and political institutions to the brink. In early 2025, one of Denmark's largest pension funds, Akademis Pension, made a bold move by blacklisting Tesla. The fund sold off its remaining shares and added Tesla to its exclusion list, citing Musk's volatile public actions and Tesla's failure to address mounting concerns about labor rights, corporate governance, and political interference. Akademis Pension's CEO Jen Monk-Holst didn't hold back in his criticism, stating that Musk's actions were damaging Tesla's brand and reputation. Akademis Pension wasn't alone. Pension Denmark, another major fund, followed suit, unloading 400 million kroner worth of Tesla shares. This decision was prompted by Tesla's refusal to sign a collective bargaining agreement in Sweden, which sparked labor unrest that quickly spread across Scandinavia. Strikes erupted at Tesla service centers, and solidarity protests spread to Denmark and Norway. Tesla's operations in Sweden were in disarray, with workers halting deliveries and service stations going offline. As the crisis deepened, unions in Denmark and Norway warned of blocking Tesla shipments in solidarity with Swedish workers. Tesla's image has suffered immensely, and in January 2025, the company's sales in Europe plummeted by 45%, while competitors saw a 37% increase. Analysts noted that Tesla's once unshakable dominance in the European market was rapidly slipping. Corporate car fleets, once a major market for Tesla, saw stagnant or shrinking demand. Meanwhile, new electric vehicles from European and Chinese automakers flooded the market, making Tesla's aging lineup seem increasingly irrelevant. A January 2025 survey revealed that 59% of UK electric vehicle owners and potential buyers would now refuse to buy a Tesla, citing Elon Musk as the main reason. What was once a cutting-edge, eco-friendly status symbol is now seen by many as a badge of dishonor. Hashtags like #TeslaTakedown and #Swastikars have gone viral, fueled by outrage at Musk's controversial political ties and rhetoric. Musk's increasingly divisive political stances have become the primary catalyst for Tesla's unraveling. His endorsements of far-right figures and movements have sparked alarm, not only in European political circles but also among ordinary consumers. His public support of Germany's far-right AfD party, alongside his clashes with UK Prime Minister Rishi Sunak and ties with right-wing populist leaders in Italy, have alienated many potential Tesla buyers. Musk's stance on climate change, once heralded as a strength, has now turned into a liability as he increasingly voices skepticism about climate science and supports climate change deniers. European regulators are now scrutinizing Musk's social media platform X, formerly Twitter, for its role in spreading disinformation and extremist content. The risk is real, as Musk's influence online could sway public opinion and even elections in favor of far-right ideologies. In response, European authorities are considering sanctions to curb Musk's disruptive behavior. Europe's growing frustration is not limited to Musk's actions alone. The broader geopolitical tensions between the US and Europe, especially in light of Donald Trump's renewed interest in Greenland and his aggressive trade policies, have further fueled Europe's anger. European leaders have vowed to defend their sovereignty, warning Washington that any attempts to undermine their values will be met with fierce opposition. Tesla's fate is now deeply intertwined with these geopolitical tensions, and the company's struggles are a microcosm of a larger shift in the transatlantic relationship. Musk, once a symbol of innovation and environmentalism, is now viewed by many as a provocateur, undermining Europe's social, environmental, and political order for his own personal gains. As Europe braces for further pressure from Musk's actions and Trump's foreign policy, it's clear that figures like Musk and the companies they lead will face resolute pushback. Tesla's woes reflect a broader struggle where values like environmental protection, labor rights, and national sovereignty are being tested. Musk's actions have cast a long shadow over Tesla, and it remains unclear whether the company can survive the storm ahead. That's the latest on today's top stories. What do you think about Tesla's unraveling? Elon Musk's growing political interference, and Europe's increasing pushback. Share your thoughts in the comments below. Stay informed, stay curious, and we'll see you next time. Take care!